4.5%. What is that terminal rate for you now, for your base case?
Well, historically, the Fed has never stopped its tightening cycle before the rate has got above inflation. And if we think of what the market's pricing for inflation, we still have inflation in the US around 5% at the middle of next year. So until the policy rate gets to that inflation rate, we might be in a period of continued sort of Fed hawkishness until they collide at around maybe that 4.755% at the middle of next year.
I mean, then you got Mark Mobius suggesting we could have interest rates as high as 9%. I mean, what do you make of that? Was he just flying a kite, ultimately?
That's a big number, and maybe more sticker shock than reality. I think the world would not be able to cope with US bonds towards 9%. And even now we're seeing stresses in various markets when, given the pace of rise in real yields in particular, whether it's in the US or the UK, there's volatility abounding already.
UK, do you think we've seen, I guess, some sort of reversal? Has confidence been restored enough in your eyes, or are we still seeing quite a bit of dislocation?
No, not yet. The announcement effect, or the sticker shock of the mini budget, completely misnamed, is going to continue for some time. And probably the next hurdle is the rating agencies. So I think we have two rating agencies. Their next review is on Friday. So some of them have already put the UK on negative watch. It's not a base case that they get downgraded, but that's sort of the path for the UK. And when it comes to thinking about UK gilts, we look at the spread of UK gilts to, say, European bonds and US Treasuries, and we think there needs to be a bit of a premium in UK gilts to pay the investor for that additional volatility and risk. And that premium is a bit tight at the moment, so cautious on UK gilts.
Well, I suppose you've got to be. I mean, this goes to our question of the day, actually. And we get CPI out of the UK later on, and we're looking at a 10% handle here. And our question is, will 10% inflation break the gilt market?
Well, it makes it very difficult for the gilt market to rally when the BOE has to respond to that. And let's not forget they have announced they are going to embark on QT from next week. So, again, we might have seen some relief rally in the UK gilts as they pull back from that mini budget. But I think the path of least resistance over the medium term is still for higher gilt yields.
But QT, as you mentioned, how does that dovetail into what the Fed is doing too? And the lack of liquidity, is it down to QT or is it deeper than that?
We think QT is just part of a general monetary policy tightening cycle. But what our analysis shows is QE, for example, dampened bond market volatility. That's non-controversial. So QT is likely to increase market volatility, and that would typically require a term premium to become more compelling in the bond market. So a term premium or higher yield is likely to be the case going forward.
Hold on a second, Brad. We have some breaking news coming through from Korea right now. The Kakao co-CEO, Nam Kon, has resigned here. This is after, of course, they were dealing with some service disruptions here recently. Kakao to prepare compensation plans after the service outage as well. So some fallout here in light of this service disruption here. The co-CEO has now resigned. Let's bring it back to Brad here and talk a little bit more about just overall market sentiment. You talked about this kind of meltdown we're seeing in gilts. I'm wondering, where do you see the next kind of signs of that happening in the bond market? I mean, people are talking about Japan, right? When maybe the whole kind of lesson of loose monetary and fiscal policy is just maybe a canary in the coal mine for countries like Japan, which continues to go this path. Do you agree Japan is kind of the where we should work for next?
I'm not sure Japan is going to have a UK moment, but certainly there are cracks appearing in the JGB market that imply the market is preparing for the BOJ to have to tweak YCC earlier than anticipated. If we look at sort of 10-year JGB yields, those that are being bought by the Bank of Japan are sticking at 0.25. Similar maturity bonds not being bought by Bank of Japan have risen to 0.35%. That's quite a big gap. Yeah. And that gap appears to be the market expecting the Bank of Japan to have to join the tightening party.
You're talking of that. I mean, you're seeing bid and ask prices actually widening.
No, not the bid-ask spread, the actual level of yield. Right. So same maturity bond, like on the run, off the run, but BOJ buying versus BOJ not buying, that spread is widening, which is an indication the market is selling those bonds that the BOJ is not buying quite aggressively.
So tell us, what does the Bank of Japan actually do? I mean, it does seem that they are subscribing to Einstein's definition of insanity of doing the same thing over and over again and hoping for a different result. Do we have to wait till Haruhiko Kuroda goes next year?
That would have been our base case probably until about a month ago when we saw these indicators that the stress is developing. So now we think maybe there will be some measures for a tweak of YCC maybe in Q1 before Kuroda leaves in April.